Would you like to be able to predict the Bitcoin price and entry and exit points correctly? We have a useful tutorial with a simple explanation about what is funding rate and what are the impacts of funding rate on Bitcoin and market situation. Stay with us. First, we're gonna learn some base information. Generally, we have two different types of market in cryptocurrency market: spot market and futures market. In the spot market, currencies are traded for immediate delivery. You pay and you receive it immediately. On the other hand, futures market is based on the delivery of the asset at a future date. You will pay and sign a contract for a dated future, for example 2 months later, and you will receive your asset at the date of contract. There are many cryptocurrencies which are traded in futures market like Bitcoin, Ethereum, Ripple, Binance, Dogecoin, and also there are many exchanges that you can trade in futures market easily. Now, what are the benefits of futures market? In a traditional market, you have to buy at low price and sell at higher price in order to gain profit. But in futures market, you can get benefit from both downward and upward trend. Also, futures market allow investors to gain exposure to specific crypto without having to hold it, like a futures contract for a commodity or stock index. And another reason is that you can get more profit than usual. Here's an example. Imagine that Bitcoin's price is now about $32,000, and you analyze the market and believe that 2 months later Bitcoin will be $36,000. So you sign a contract and buy Bitcoin at a price that is more than current, for example $33,000. It may be $1,000 more than current price, but as you believe that if the price would increase next 2 months, so you still gain $3,000 more profit. Of course, calculating futures price has its own formula that we are not going to discuss now. We just try to give you a general view about this issue. Futures market contracts are divided into two groups. One is general futures contract, which is a binding agreement to exchange a crypto asset at a specific price and a fixed point of time in the future, exactly like last example that we discussed. Another is perpetual future contracts, which comes with the added advantage of leverage and does not have a predetermined expiry date or settlement like normal cryptocurrency futures. Instead, perpetual futures have no expiry date and therefore exist in perpetuity. In a perpetual futures contract, first you open a position. Depending on your decision, you can open a long or short position. You stay at this position as long as you like. The exchange will automatically expire the position. Most of the exchanges expire, for example, every 8 hours. And you can extend the position as many times as you want. In a perpetual contract, there is a matter that should be concerned. There is the danger that traders may be able to manipulate the market price with the leverage they hold. In order to avoid price manipulation, traders must pay a fee named funding fee to stay in the position. Funding fee or funding rate is a periodic payment, either to traders that are long or short, based on the difference between perpetual contract markets and spot prices. So depending on open positions, traders will either pay or receive funding. Here's an example. Imagine you buy Bitcoin for a long position with this prediction that the price will increase. So there is a difference between the futures market that you think the price goes up and the spot market, the current price of Bitcoin. So for staying at this position, long buyers must pay funding fee to short buyers. Therefore, staying in position has a cost for them. Paying this amount 3 times a day for a long time, this is something that prevents manipulating the price. Now, when does funding rate matter? Usual funding rate is about 0.01%. This is the fair amount that traders pay and stay in their desired position. When price of an asset increases, more traders enter a long position with higher price prediction, and that makes funding rate increases too. If funding rate increases for a long time, it is not worth paying this amount and stay in position. Therefore, traders must sell their assets, and when everyone starts selling, the price goes down. Look at this chart. The red diagram is funding rate, and the black diagram is Bitcoin price. On 7 January, the funding rate was about 0.0619, and you see after that, the price of Bitcoin dropped. On 9 February, the funding rate amount was 0.15, which is really a high amount, and after that, Bitcoin price dropped dramatically. On 14 March, 10 April, and 6 May also, the same event happened. So you see that when funding rate amount increases much more than usual, which is 0.01%, there is an alarm. And one more thing that you should know is that funding rate fluctuates around the zero line. Positive funding rate shows traders like to buy, which is a sign of a bullish market, and negative funding rate shows traders like to sell, which is a sign of a bearish market. So by checking the amount of funding rate, you can predict the price and analyze the market much more better.
Okay guys, if this video was helpful for you, please like it and leave a comment for us and write about the issues you're more interested to make a video about. We publish important news about cryptocurrencies which have significant impact on market and prices. And also we try to make useful tutorials to raise your awareness and knowledge about cryptocurrencies. So please subscribe the channel to receive latest videos. See you soon!